course. Can I take your name?
Hi everyone, Mark here at Fortune Financial with Kate Somerville, Senior Mortgage Advisor. We promised to put a video together and get it over to you guys that are going to be advising in the mortgage world, especially those who have recently been appointed by Primus. We're going to now want to kind of look at the job in hand. We're going to cover some areas like checking affordability and budget for clients. We're going to look at the 27 Tech sourcing system. We'll also talk about our client preparation forms that we use, which are digital forms to essentially collate the information prior to your appointment. And also we're going to talk about documents and the documents required, to assess your clients by means of making recommendations, but also to be able to kind of move forward with a mortgage and make sure you're meeting the requirements of compliance with Primus as well. We're then going to come on to lender criteria, which is a big one. Of course, you need to know where to put your business and how to know where to put your business. And we're going to talk on fact finding beyond the prep form. And we're going to really touch on fees, why it's important to charge fees at Fortune Financial, our fee agreement. And then finally, the journey. At Fortune Financial, it's not just about getting you a mortgage. It's about either getting you in your own or completing on the remortgage with a smooth process. And of course, great customer service. So, Cade, how you doing?
I'm good, thank you.
So we'll start with affordability. We get many leads through the business through, introducers, the phone rings, website, different sources, and many leads are clients wanting to know, what they can afford. Would you say that's the kind of first starting point for any client?
Absolutely, yeah. I think whether you've got a first-time buyer, whether you've got a home mover, whether it's buy-to-let, whatever it be you're looking at, ultimately, without knowing what you can borrow, you don't exactly know what you're recommending, nor what the client can then, actually have as a budget for their onward purchase or their first-time buy.
Great.
So yeah, affordability is really, really important.
So we're going to come on to the prep form. So of course, we'll have the information when it comes to assessing affordability. And of course, that's key. You can't arrange affordability without their incomes and the circumstance. But by means of affordability, can we show everybody who's watching today an example of assessing affordability for a client? And we'll just make up the income levels, the clients themselves, and make it very plain and simple that, we go to a certain lender, don't we? So I'll hand over to you.
Yeah, sure. So ultimately what you're going to have is you're going to have the prep form, which, like Mark said, we're going to come on to in a second. But with the information inside that prep form, what you want to do is confirm the information is accurate, because these are the figures that we're using to assess someone's affordability. So what we don't want to do is provide them with an inaccurate affordability assessment and tell them they can do something that they might not be able to do. And just quickly, I'll touch on that. Could be around a base salary. They might have a car allowance, they might have overtime, commission, bonuses. So you really need to understand the setup of their income and how that's paid, especially additional income like your bonuses, your commissions, etc. So once you've got that information, what you want to do is essentially you want to run affordability. Now you're probably thinking, well, who do we run affordability with? Ultimately, what you're going to do is you're going to source the mortgage briefly through 27 Tech, and you're going to work out which lenders are kind of sourcing the most cost effective for that type of product based on maybe loan to value percentage, for example. So in this instance, I'm going to touch on HSBC first. So what we're going to do is we're going to just, for the purpose of this affordability assessment, we are going to make up some numbers. So using the prep form that the client's filled out, bear me a second. Let me just
share. Good question while you're doing that, Cade.
Yeah, sure.
So lender to lender, do they all differ then with affordability?
100%. Absolutely, they do. Because not just on base income, a base salary is base salary. I think, you're going to get a very similar indication of borrowing across lenders, but ultimately what you're getting is you're getting a multiple of income, and that's what lenders are going to give you, is a multiple of income. So that does differ from lender to lender, you're right. So you'll get maybe 4.5 times income from, whether it be NatWest, Nationwide, whatever, and you may get a higher multiple from HSBC and potentially a higher multiple from Virgin.
Yeah.
So that comes down to the level of income, so that comes down to size of deposit. So again, it's all very, very different. And using a sourcing system, working out which products are most cost effective for a client versus how much you potentially need to borrow, use the two in conjunction, and then use the affordability assessment, because you won't just run the assessment with one lender and think, oh, that's great, that works. You're going to compare, especially if you're working on a figure. If a client specifically requires a certain amount of money, you might be trying to source them the maximum amount of money they can actually borrow. So what you might be doing there is sacrificing a product from, for example, Nationwide, because they won't actually lend as much, and skip to HSBC because their multiples are better, or they would lend more based on the commission or the bonus that the client earns, because it's underwritten slightly differently. They might take 100% of that bonus, as opposed to Nationwide that might only take 50%. They're examples, by the way, so don't quote me. So yeah, just put that out there. So this affordability assessment here is with HSBC, and it's a very simple one, actually. They differ very much as well. Some are a little bit more complex than others. Some require additional information. Some require limited information. But in this instance, we've got, for example, buying first house. So it's a purchase and it's buying first house. It's a joint application. So it's Mr. and Mrs. Maximum LTV. So this is actually a really good example. I just spoke about multiples of income. So what you'll see here from HSBC is what they'll offer is two different multiples, or several different multiples, based on loan to value. So if the client's looking to borrow anything up to 90% of the value of the property, they're saying that loan to income, which essentially is a multiple, they'll offer 4.49, 4.75 / 5.5 times subject to salary.
Yeah. So
the 5.5 times multiple will be if it's a higher earner, usually above £100,000 a year, for example. But if you're looking to borrow above 90%, the multiple is going to stick at 4.49. So they're not going to get as high a multiple, and that's purely from a risk assessment from the lender. They're not going to offer as much security on that property based on a smaller deposit. So for the purpose of this, we're going to choose less than or equal to 90%. So that's anything borrowing under 90%. The first applicant is 30 years old, and the second applicant is 31. They're both employed. Again, nice and simple for the purpose of this assessment. And they're currently living together. There's several options there. They can be single, living together, married, but they're currently living together. They're renting, for example. Whether they've got dependent children. So dependent children is anyone who is financially dependent. So you could have someone who's 19 years old still living at home, and if they're financially dependent, then that would be classed as a dependent. In this instance, there's no children. So what we're looking for is the client is looking to purchase a property, for example, at £400,000, and they've got a 20% deposit. So the deposit value would be 80,000. And the loan amount would therefore be 320,000. And it also asks for the property value as well, which is 400,000. So deposit amount, loan amount, property value. The mortgage we're looking at, we're doing it over 30 years. Now, the term's quite important from affordability assessment, because with some lenders, the longer the term of the mortgage might increase the amount the client can borrow, because the monthly mortgage payments are more affordable, therefore they get more net income, therefore the lender might lend more. It's not an interest only, so we're going to skip to the next one.
On that one, before you move on.
Yeah, sure.
Quick question. So we've got a client, let's say, who wanted a 20-year mortgage and they want to borrow the 320,000, but on 20 years, the max loan is 300,000. Now, they can take the loan for longer because they're not going to retire. They're going to continue working. Okay. Would that be an option then to say, take the year for 25, maybe 30 years to increase the affordability to meet it? And then, am I right in thinking they potentially can overpay if they want to kind of bring that term back down?
Yeah, correct on both accounts. So where I referred to a second ago around increasing a term to potentially borrow more, absolutely, as long as it's within that client's retirement age. Because don't forget, what we're doing here is we're offering up an income to a lender as the source, as the driver for affordability. So what the lender's going to want to be confident of is that your income is sustainable throughout the term of the mortgage. So if the client's 30 years old and they want to retire at their anticipated retirement age, say, is 65, well, we know that we're not going to be taking that mortgage for longer than 35 years. Because if the client's retiring at 65, that employed income that we're looking to use will no longer be there. So absolutely, if we're looking initially at 20 years, because the client's preference may be for a 20-year mortgage, they want to be mortgage free, early by the age of 55, for example.
Yeah.
If we didn't quite get the loan we required, if the affordability did fall short, we could look at absolutely increasing that term and therefore potentially increasing the amount we borrow. And that's a conversation you have with the client. Say, look, we can't get you on 20 years. However, if we extend that term to 25, what we can do is increase the amount and meet that affordability assessment.
Yeah.
And then in answer to the second part of your question is that they can actually reduce that term throughout that 25-year period by using the overpayment facility. So with, I'd say 95% of mortgage products out there now will have an overpayment feature whereby the borrower could overpay on their mortgage, usually up to 10% every year. So if you imagine you've got a £300,000 mortgage, you can overpay £30,000 in year one and 10%. It's a big chunk, yeah. So by doing that, what you're doing is reducing the amount of capital on your mortgage, reducing the amount of interest payable, which is key as well. But of course, you're going to have that debt paid off sooner. So as much as the initial term was 25 years, you might be shaving some substantial amount of time off that mortgage over the next 10, 15 years and bring that term back down.
And that 10% as well, that doesn't have to be a lump sum of 30,000. It can be, as and when, and change your direct debit month to month to reflect, or alternatively, it can be a lump sum, can't it?
Either or, absolutely. Yeah, you can pay it on a monthly. So like you say, you can amend the amount you're paying per month, add a few £100s, couple of £100s on it, or whatever, as little as that. Or if you get an annual bonus and you're very savvy with your money and you think, what's the best way we can use this bonus, then yeah, £10,000 bonus at Christmas, phone up the bank and pay a lump sum off.
Great.
Either.
Brilliant.
Yeah, absolutely. So gross income. So we've got applicant number 1 earns £50,000 per year. Applicant number 2 earns £55,000 a year. And additional income. So again, these assessments are very different than to lender, so make sure you understand what they're asking for. In this instance, HSBC simply want, you can see there, if I hover over that question mark, it's asking for me to key 100% of any other income, bonus, commission, whatever it be, and HSBC will use 50% of it as part of the affordability assessment. So this client earns a £5,000 bonus every year. And usually what you need to check the criteria with lenders, because how they assess that bonus, it might be that they will average the latest 2 years annual bonus. So if you've got 4,000 in year 1 and then the previous year you receive 6,000, of course the average will be 5,000 over the 2. So it won't necessarily be the latest figure, it will be an average of the 2 usually. But again, that criteria differs from lender to lender. Applicant 2 doesn't have any bonus income, so we're going to leave it at that. Depending on what other type of income you're using, you might be looking to use limited company net profits, other non-taxable income, and if they've got maybe a buy-to-let in the background where they receive rental income, you can use those two. Again, subject to criteria, you need to confirm that it fits criteria for a lender. So we're going to hit next step, and this is regarding expenditure. So most lenders will only want to, within the affordability assessment, will only want to know about committed expenditure. So that's things like credit cards, loans, car loans, student loans, service charges on flats, leasehold flats. How much they're spending on travel is usually a key one as well. Childcare, if you're currently paying out childcare for after school clubs, or if they've got very young children.
One, can't it?
But yeah, it's a big one. It's a big one that can a lot of time get forgotten as well, because clients don't understand, of course they don't understand that it's actually considered for a commitment. They think it's just a childcare cost that they pay. And sometimes what you'll see when you get pay slips as well, that sometimes they use the childcare vouchers, so they'll get it, it's tax deductible, so it's more cost effective for them to do it through a tax deductible scheme, so it gets deducted from their pay slip. So unless they're telling you about it, you might not see it until you get documents. So that's why documents are really, really important as well.
And with the expenditure, just while we're talking about this, what are lenders assessing is the client's circumstances once the mortgage completes the majority of the time? Or are they assessing the circumstance of the clients right now? So as an example there, if someone had a loan that they paid out and it was £200 per month, that's going to have a negative effect on the affordability if it was to remain with that mortgage. If that had, I don't know, one payment left on it, would it be something we'd have to disclose in the expenditure, or could we kind of disregard that?
Yeah, great question, because loans, monthly payments, especially loans, especially if it's a large loan, you can have quite high monthly payments. So anything around, £200, £300, it's a massive lump sum that's coming out of that client's net disposable income. So you're right, it can have quite an adverse effect on the borrowing. As for credit agreements that are in a very sort of the latter part of their agreement, like you say, if there's a month left, 2 months left, check the criteria, because the rule of thumb, I say rule of thumb loosely, but the rule of thumb is that any personal loans or any credit agreements that have less than 6 months to run, which means that it's going to be paid in full within 6 months, the lenders usually disregard that monthly payment. So that's great for affordability assessment, because you may have like we said, a large chunk of money going out per month on a personal loan or a car loan that actually is going to be settled within 3 or 4 months.
Yeah. And we've talked a lot about, lender criteria, and we're going to come on to that. I suppose lender to lender, some will have them rulings, some won't have them rulings. So it is a matter of, finding which lender is the best fit for your clients based on, the current circumstances or the circumstance that it's going to be with regards to their expenditure then.
Exactly that. And we've said subject to criteria so many times already in the first 15 minutes. And it really is, because don't take it for granted that because one lender does it, the other one will, because they may well assess it very, very differently. So just check the criteria, and we'll come on to that in a second, how they assess that. And if they can't get the answer, there's many ways of getting the answer as well, which we'll touch on shortly. Understand what the commitment is, how long it is there to run, what the monthly payment is, what the outstanding balance is, and that's what they're after in here. They're after that committed expenditure. So we're going to, for the purpose of this affordability calculator, we're going to say this client's got £5,000 on their credit card, and this client's got a £1,000 balance. They both spend approximately £250 a month on travel, to and from work, petrol, etc. And we've got no children, so we've got no childcare costs, and they haven't got any loans. It's just the 2 credit cards they've got. Watch out for things like this. So existing monthly buy-to-let outgoings, because if you're looking to use income from other areas other than employment income, the lenders might want to know, actually, is there a commitment to, for instance, if you've got a buy-to-let property in the background that is generating you an income, what are you paying towards that? So it's all good and well that they're going to use the income, but they're going to want to offset potentially the costs of that in the background as well.
And again, that's doing your research across the lenders, isn't it? To kind of see, will people disregard buy-to-lets? Sorry, lenders disregard buy-to-lets. Do they want to know the ins and outs of the buy-to-lets? Do they going to take into consideration the maintenance of them as well? So
exactly
some lenders will favour against others as well. So again, it all comes down to criteria that we're going to come on to.
Exactly that. So we're going to leave that blank because there's no background property. So I'm going to hit next step. So it's going to give me a result. So you'll see here that it's given me 2 results, in fact. The first result is total lending amount based on estimated property value. So if you recall, what we put in there is we put a property of £400,000. And we said that the client had 20% deposit, which would have been £80,000. And what HSBC are saying here, they're saying actually the client can borrow up to £360,000 for that particular property value of £400,000. So they're saying that the client can borrow up to 90%. That's what they're saying there. And the next figure here is just giving you, again, it's different from lender to lender. You do get different figures and different assessments. But what they're saying is based on their actual income, the client could actually borrow over £600,000. obviously music to many clients' ears if they get that kind of figure back. But
and music to your ears as an advisor, because it's an easier find.
Exactly that. It's a much easier conversation. It's a much it's much more comfortable affordability assessment. So it gives client options. When you're moving on to things like agreement in principle, you're kind of confident that you're going to get a decent return on the assessment. So yeah, that was a nice easy one using sort of basic figures there. But that's just an example of one lender's affordability calculator. And like I say, they do differ. Some lenders will want to know about pension contributions. Are there any deductions on pay slips? Things like that as well that they take into account. So in that instance, you'll actually need your documents. So you can't really be doing this after you've only got half the information. So along with the preparation form that we spoke about and actual evidence of documentation to evidence that income, that's really where you want to be to get an accurate result.
Great. So with the affordability calculators for the lenders, you'll see at the top of the page there, what Kade's showing you, it says intermediaries. So if you was to type into any web browser, the likes of Google, the lender you want, whether it's Santander, Nationwide, Barclays, HSBC, Halifax, with the word intermediaries, and then affordability calculator, you'll find it on their website. And these websites are for you as advisors. So, Kade's showing you there the Santander site. There's an affordability calculator, very similar. You'll fly through this. You'll show them how quick it is. You can make up the stats. You'll get the results at the end. No real necessary need to go into it again. They all are very similar. And I suppose most brokers use the likes of Halifax because it's so quick, maybe NatWest, because they ask 3-4 questions and then you get a result. Now, am I right in thinking that these calculators, they're an example, aren't they? They're an indication. It's not set in stone with regards to what they're going to get and be offered.
Absolutely, yeah. They'll say that at the bottom, that it's not an agreement to a loan. It's not an offer of a loan. It's purely an indication. Because the figures you're putting into the calculator, you're not providing that to lender at all, because it is just an online calculation. So once you've completed that agreement in principle or decision in principle and provided the accurate information on income, expenditure, and once the credit check's done as well, because that can sometimes affect affordability, someone's credit status. So until you've got an AIP or a decision in principle, it is all indicative, yeah.
Great, fantastic. So we'll come away from affordability calculators, but just before we do, I'd encourage any advisor that's watching this, that's going to be giving advice, to spend some time training on these and just, create Mickey Mouse, as we always say. Give him some income, give him some expenditure. And it is as with anything in life, income minus expenditure tends to give you the ability to borrow what you can borrow. Now, of course, everyone talks about multiples of salary. Yes, it does tend to work on multiple of salary, but as we've explained there, the expenditure is a big factor against, the result you're going to get. So lenders will differ from lender to lender. And what we're going to do now is show you the 27 tech system just for 2-3 minutes. We're not going to spend a lot of time on it because we've done this before on the Sharpen the Saw event. But of course, this sourcing system is what primers are going to give to yourselves to be able to source from the comprehensive panel we have and really pinpoint down on who's the most cost effective, or alternatively, who's the strongest rate on the market based on your filter options. So over to you, Kade, 27 Tech. Still muted, Kade.
That is a classic Zoom move. Right, so this screen that you see now, that's essentially the home screen of 27 Tech, which is our mortgage sourcing system. On the left-hand side here, you'll have different options, but ultimately, this is kind of where you'll be working in the most is mortgage. And then there's 4 tabs, and what you don't need to do is complete all of the information in this tabs, but I'll go through quickly what's key in regards to what information you need to be putting in. So the first tab being mortgage requirements. So we've spoken to this client, and they're looking at a property at 400,000. They've told us they've got an £80,000 deposit. So they're looking for a mortgage of 320. So in conjunction with assessing affordability, what we're going to do, we're going to go and look at what kind of rates and what kind of products and what lenders we're going to lean on in the first instance, because, like Mark said, because they're the most cost effective on the market, and we'll go through how we assess that as well.
I'm going to challenge you here, Kade, on the spot.
Yeah.
I want you to find me a 2-year fixed rate
Yeah.
I don't want to pay an arrangement fee.
No fee. Okay.
I'm going to be the client on this one.
I'm going to challenge you that on back on that as well then. So what we'll do, that's good. That's a great example, because a lot of clients will say that. I say, oh, I don't want to pay a fee. I don't want to pay a fee. They're very adamant that they don't want to pay the lender a fee. So we'll go through the options they've got with regards to that. So we're looking for a standard residential, and we're looking for a purchase, not a remortgage. So we know that we're purchasing at 400,000, and we know that we're looking for a loan of 320. As soon as you hit enter on there, what it will generate is a loan to value percentage for you. And you can work in two ways with that. You could, apologies, it did this to me on the last course as well. Last time we did it, bear with me a second.
Just while you're doing that, Cade, obviously the loan to value has a real impact on the interest rate. So that, you know, the bigger deposits, the more security for the lender. So as you'll find, as that loan to value drops, you're going to obtain, you know, better products from the lenders. So, you know, you got to keep an eye on that as an advisor, you know, because for example, if it was at 81% and products were released anything below 80, then they might be missing out by just putting that extra deposit in, that little amount extra to qualify. So again, keep an eye on the loan to values and make sure you're meeting the brackets of the products as you move forward. But, you know, we do tend to find that people have the deposit that they have, but you never know. They might have some tucked away that they can just meet that shortfall to make it more cost effective for them.
Exactly that. And that's what I was kind of going to do here as well, because let's say, for instance, a client said, I've saved £78,000. Okay, well, if they've saved £78,000 to buy this property, they'd need a mortgage of £322,000. What that does, you can see it just jumps over the 80% loan to value. And what that's now going to do is that's now going to eliminate all of the 80% loan to value products and only show the 85% loan to value products. So the rates are typically going to be higher. That's a conversation to have with the client. So look, Mr. Client, you've got £78,000. I mean, is that your absolute maximum? If you've got a rainy day fund, because by simply adding maybe another £2,000 to your deposit, we can get you a better product. We can get you this product, which is going to save you X amount of interest over the next 2 years, because we're looking at a 2-year fixed rate, for example. So absolutely keep your eye out for that, and see if there's any sort of wiggle room, we call it, essentially. But it might be too far away. They might only have £65,000. So for them to get to £65,000 to £80,000, that's a massive jump. So it might not be a possibility at all. Yeah. But if it's close, just keep your eye on it. Have that conversation with the client for sure. So we were looking at, let's say we're looking at a 30-year term, weren't we? So that's the information required for the first page, which is pretty much just around the mortgage itself. Things like source of deposit, we usually say leave that blank, because unless it's very obscure, then what you'll be doing away from this is going back to criteria, intermediary sites, and establishing which lender's right for that client based on maybe their actual source of deposit. But for this purpose, we're going to leave it blank. And the repayment method is repayment. We're not looking at interest only or a part and part. The next tab is applicant details. I would always just put the client's name and surname in here, because it will save and it'll be easier for you to refer back to when you want to go back in, play around with the figures, or resource it because rates have changed, for example. The next tab is property details. Again, you may not have a property that they're actually looking at, because we're working on just affordability and what they can borrow and potentially what kind of interest rates we can get them. So just change that to England, because that will filter out any Scottish related products, or any properties in products in Wales, etc. And then filters. This one's very key, because what the clients asked for here is a 2-year fixed rate. So what we're going to do, double click that.
You got one, lad. Come on.
Let's see what we can do for you, Mr. Client. Right. Fixed rate, 2 years. You also told me you didn't want to pay a fee. Okay. So down the right-hand side here, we've got preferences. So there's all different types of preferences. I'm going to go through each individual, every one, but what the client's asked for is, I don't want to pay a fee. All right, brilliant. That's fine. I'm going to click here, free lender fees, which means the lenders won't charge any fees. And also, because you told me you didn't want to pay a fee, it's likely that you won't want to pay a valuation fee either. So I'm going to tick that as well. So I've got those preferences. So what that's now going to do is filter out all the lenders, all the products which have a product fee applied to them. So this is referred to as an arrangement fee, a product fee. It can be used, different terminologies used for it. So I'm now going to hit search and let's see what comes up. So you'll see it's given me all the lenders down the left-hand side. It's an ascending order. So it's gone from the lowest rate at 2.15, and you can see it's ascending from there. And each column's giving you different information here. So you've got the lender, the rate, how long the rate is fixed for. So we've selected 2 years, but they do differ. We'll come on to that in a second. The initial monthly payment, how much it's going to cost the client per month. LTV, things like fees and cashback. So you'll see that there's minimal fees for each individual product here. We click on this little pound sign over here, it will tell us what that fee is in relation to. So it's a CHAPS fee, which essentially is for transferring of funds, and a discharge fee when the client pays that mortgage off of £80. So there's no product fee, there's no lender fee, there's no arrangement fee, there's no valuation fee. And that's the same for each individual product down here. So Barclays Bank, 2.15%. That
I want it, Mr. Advisor. I want it, Mr. Advisor. It's the best rate on the market. Please, can I have that?
Like, you sound like a client there, Mark. So, absolutely, it's the lowest rate on the market. So, is that the product we're going to be recommending to the client? Possibly, possibly not. So, why are we not going to jump in two-footed here and say, right, yeah, great, got your lowest rate on the market. You've got another broker that told you then get 2.24. I can get you 2.15. Well, actually, can you? So first and foremost, do they qualify for Barclays Bank product? Does it meet affordability? Does it meet property criteria? Is their income type acceptable? Is their employment type acceptable? There's lots of different reasons why we need to establish whether we can actually offer that client the Barclays Bank product. And when you hover over the lender's name, it will tell you a little bit more about the product. So this is a 2-year fixed, no fee, new build, green home. So that's a specific product that is for new build homes only, and also a green home, which means that it has to have an energy rating between A and B, energy rated, which a lot of new builds they're building in much more efficient now, become much more energy efficient. But if this is a home mover, someone looking to move home, or a remortgage, for instance, they don't qualify for that product. So we can't actually have it. So be careful saying that we can get you a 2.15. It's the lowest rate on the market. Yes, it's all indicative at this point, but just do your research on the product and the criteria to ensure we can offer that. The second thing we're going to do actually is work on something called true cost, because as much as this product here is the lowest rate on the market, what we need to establish actually is the most cost effective. And you're thinking, what does that mean? Well, actually, what it means is that as much as we've chosen there's no fee, no valuation fee, you can see there's elements of fees involved, whether it's just discharge fees, admin fees, things like that. So what we need to do is we need to establish which product is most cost effective. And we're going to do that over a 2-year period. I'm going to calculate
clicked on your button at the top that says true cost and fee details. And that enables you right the product term in that you're kind of looking for. So this one's a 2-year, wasn't it? So
exactly that. So we're going to put in 24 months to give us a like-for-like comparison of all of the products that are sourcing. And we're going to include all types of fees in this. So booking fee, even CHAPS fees. And what it will do is it will give us a total cost, a total amount of money that's payable over 24 months. So not over 30 years, taking into account variable rates and such. It's going to give us what the true cost is over 24 months. And you'll see this column here is now, again, ascending from the lowest true cost over 24 months. And it's ascending from then going upwards. You can see it's for 14 pages long.
Now, due to my request of no fee, of course, Barclays would tend to stay at the top, wouldn't they? But if we can remove that fee-free filter, and just show how it differs.
Absolutely. So I'm going to turn true cost off again for a second, because I want to show you how it changes significantly. So we're going to go back to filters. We're going to take out free lender fees. We'll take out free valuation fees as well. So now we're just looking at 2-year fixed rates across the market that we've got access to. So scroll down, hit apply filter.
And this is how you should work as an advisor. You shouldn't take the instruction of the client. You know, I want a fee-free product. Don't get me wrong, you might end up with one, and it might be what's best for him. But at the same time, you're an advisor, and you need to let them understand that there is a true cost. It may be better to take a higher rate with a lower fee, or alternatively, is a lower rate with a fee better? And that's what Kate's going to come on to now.
Exactly that. So you'll see here that the interest rates, again, it will source at the lowest interest rate initially and ascend from there. So we're looking at this, and just for the purpose of this exercise, I'm going to ignore that it says green new build only, just for the purpose of this exercise. But ultimately, what this is telling me is that Virgin is the lowest rate on the market. And the client might want that. I want the lowest rate on the market. But actually, like you say, you've got to stand up tall and advise the client, actually, Mr. Client, understand what you're saying, but let me see which product, let me recommend to you which product actually is the most cost effective for you. So because if you look at Virgin Money, it's got fees attached, it's got a cashback as well, for example. But there are products out there with lower fees. For example, Barclays Bank. It's only a smaller fee, much smaller than Virgin Money, but a slightly higher interest rate. So how do we assess which product is more beneficial to the client? So going back to what we did a second ago, true cost and fee details. We're going to click on that. We're going to calculate over 24 months, and we're going to hit update true cost. Let's see what it does to that list. There we go. We're actually back to Barclays, how ironic. So that Virgin deal that was 2%, you can see there it's now shifted. And we've got Barclays, NatWest, Virgin, and HSBC that actually are more cost effective. So why? If we scroll across now to that true cost column, you'll see that figure, £29,081 and some pennies, is the lowest true cost figure, and it ascends from there. So Virgin have now gone down the pecking order because their true cost over 24 months is actually higher. So for this client, in this instance, it's actually more beneficial to take a higher rate with no fee, as opposed to a lower rate with a fee.
For sure. And what's the little key mean next to the lender product, please?
That's really important. That's exclusive. So what's great about these products that show with the key is they're exclusive, and they're exclusive to us and Primus Mortgage Network. So what that means is that the client cannot go to Barclays and get that product. It means that if they are speaking with another broker, or they've already spoken with another broker and they're not part of Primus, there's many brokers out there, then ultimately we're going to be able to get them a better deal that they've been advised elsewhere potentially as well. So like I say, it's exclusive, so only you are the one that's able to get that client that deal. So that's really, really important, because it is a bit of a USP, you know, a bit of a selling point there for you guys to have a discussion about that with your clients.
Just finally on this one, you want to choose that product. We want to get the illustration now. Where would we go to do that, please? Absolutely.
So what we're going to do is we are going to click on it. So we're just going to, again, we're going to ignore what comes up. We're just going to, we've checked criteria. We know that's the product we're looking for. So you can see it's highlighting the line as I'm hovering on it. So I'm going to click it, and it takes us into the product. It gives us much more information. I'm not going to go through it all, but it gives us loads of information about the products, eligibility, things like incomes, product conditions, fee details, property, loads of information for you to go through. But to generate an illustration, you'll see up in the right-hand corner here now, these tabs have changed, and you've got several different options. But ultimately here, we're going to click on illustration, and it's going to bring up a summary box. These are grayed out, these sections here, because that's information we inputted in the first instance, so we can't change that unless we go back. And we've got the client's name, and we've got fees. So there's several information, but it's an advised mortgage. Of course, we're advising it. There's no adverse credit for the client. What kind of fees are related to the mortgage? So all these different fees that they're going to have to pay. Are we adding these to loan, or are we paying on complete? You can change it from completion to application. But ultimately, don't forget that I'm charging this client a fee as well. So I'm actually charging this client £999 on application for this mortgage. So I've added that in. You can see the application fee. There's several fees that you can add, but in this instance, it's a broker application fee of £999. Once you've done that and you're happy with the fee structure and whether you've adding certain fees to loans, what you'll do is you'll hit generate illustration. And that will simply produce a PDF document that you'll see popped up in the bottom of my screen over here. I'll click on that, and there is an ESIS mortgage illustration.
Where do I sign? Brilliant. That's good.
Absolutely.
Just to jump back slightly, you'd have seen a fee there for this purchase that talks about conveyancing. Do you know why? Because I actually don't know the answer to this. Legal fee. I feel it's just an example of a legal fee, and I always delete that because that's not a cost that's coming in with this. Of course, the clients will either arrange their own conveyancing, but we'll obviously recommend our conveyancing as well. So on purchases, it does tend to throw that in, doesn't it?
Absolutely, yeah, good spot. So with legal fee, it will automatically produce a legal fee, especially for a purchase, and again, for a remortgage likely as well. But it's an indication of the costs that the client will have to pay a solicitor to do the work on behalf of the lender. Okay, so that's not going to cost them £126 for a solicitor to carry out the full conveyancing work from start to finish. Yeah. That is in relation to the fee payable to a solicitor to carry out the work on behalf of Barclays. Now, it's very rare that a client will use the solicitor that the lender has essentially recommended. So you're going to have your own solicitor, whether it's something we've recommended or, you know, a family solicitor, whatever it be. So it is an indication, you're absolutely right, because if you're using a solicitor that is on the lender's panel, which you need to make sure that's the case, then that one solicitor can act for both yourself and the lender. And there'll be one overall cost for that, which you would have, of course, obtained through getting a quotation from that solicitor. So absolutely right. You can usually you would just delete that. So you just hit the red X, it takes it away. And then you generate the illustration and it will give you a new illustration. And you can do that as many times as you want. There's, don't be afraid clicking illustration 10 times. All you're doing is overriding and creating new illustrations.
It's great. And while we're on this then, I'd say what we're going to do, we're going to skip forward just slightly on what we're going to cover today. And we're talking there about the broker fee. Now, you've added a broker fee in of $9.99, haven't you? Now, am I right in thinking that that's not a standard fee for us?
Absolutely. So you'll see from our IDD that we have a fee structure, don't we? We have a fee structure whereby we will charge up to 1% of a mortgage with a minimum fee of £500, and in specialist lending cases, we'll charge up to 2%. So that's the structure. I've just picked 999, it's a nice round figure. Yeah. But ultimately, with the fee structure, when we spoke about this on the Zoom a couple of weeks ago, you charge what you want. It's your advice, and you stand tall with that as to what you charge. So a fee of up to 1% on this mortgage of £320,000, I can charge up to £3,200. Now, whether you want to charge that or whether it's right for you in that circumstances for that client, but it's going to be different case to case. This is a straightforward purchase application, so I'm charging, a straightforward $999 fee on application. But you might be doing a remortgage, for example, where you're consolidating debt. You're putting the client in a much better financial position by consolidating a load of unsecured debt and reducing their monthly outgoings. And them cases are a lot more difficult. They're a lot more complex. They take much more.
You're justifying the work involved, aren't you, with your fee?
Exactly that.
I suppose another thing as well is that you work for a 10-year established company, Fortune Financial. We're going to talk about the journey, but we're not somebody sat in a back room at the house on a sourcing system just throwing them a mortgage and saying, if you want it, then you can go and get it. We're here to support you throughout. You become a client of Fortune Financial and a long-term client. We're going to look after you at points of your remortgages. We're going to give you protection advice, which of course comes at no cost. We now cover the cost of your will. And any other services you need by means of financial services, we can all but cover and cater for them as well. And of course, some additional costs might come in when it comes to them kind of services. But I suppose if you're getting quality, sometimes you're prepared to pay for quality. And it's client to client, the circumstance to kind of what they want to pay. So it's a mix between justifying your work and working with your customer and your client to make sure it's right.
Absolutely, yeah. Spot on.
So we have a fee agreement for our clients. So on this example, you charge $999. So the fee agreement will go into the advisor folder, won't it? And signed by the client. We do a digital signature. We fire over an email to them and they fire it back and it just goes on file. So broker fees, when do we charge them, Ked?
Whenever you want. Charge them whenever you want. I mean, with purchase applications, I tend to always charge up front on application because it's a very long process, a purchase. You know, it can happen within 3 to 6 months. If it's a new build, it might not be built until September, October time. So I tend to charge them up front on application for a purchase. For a remortgage, it's a little bit different. The process is a little bit quicker. They tend to complete, you know, in a shorter space of time. So with remortgages, correct me if I'm wrong, Mark, and you've advised in the past as well, but I tend to look at, okay, well, what do we charge this client for what we're doing for them? So again, it's justifying the work that you're doing. So if it's a nice complex case like a debt con with adverse credit, for example, then you've got the ability to apply the fee on completion.
That's correct. Yeah.
And you always have the conversation with the client and say, okay, well, we're going to charge you 2% of your mortgage. However, it's added to the loan and it will come out of the loan amount.
Very much so. And what you've got to remember is a mortgage is very simple. It's a loan. So if you've got a loan with Halifax, for example, you're repaying that loan if you're moving to another lender by means of a remortgage, and you're borrowing another loan with another lender. So the equity within your house, you know, you can borrow what you want to borrow. So if you've got an outstanding mortgage of, let's say, 250,000, if you want to borrow 251,000 and pay your advisor £1,000 at completion, that's what we do. So the fee is saying that can be built into the loan for remortgages, not so much by means of a product transfer if you're remaining with an existing lender, but if you're moving lender, then there's no real need for a customer to have to, you know, dig into their savings or their bank account and take money out of their pocket to pay the fee at completion or even an application or even offer. It can be done by means of being built into the mortgage. But I suppose the thing to factor in there is that, you know, you're going to incur interest against the fee then throughout the term of the mortgage, or at least up until you remortgage it out. So that's something to factor in for your clients. So of course, it's more cost effective to pay the fees up front. But of course, when it comes to remortgages, you'll probably find that 8, 9 out of 10 people do build it into the loan and pay it at completion.
Yeah, agree.
And it doesn't have to be one fee though, Ked, does there?
It doesn't. You can absolutely, yeah. You can put any type. I've done it before where I've actually on a remortgage, for example, I've charged, I've applied a completion fee and I've actually applied an application fee as well. And usually what I'd refer that to is, okay, Mr. Client, is what we're going to do. We're going to charge you an admin fee for the application. And that can be a smaller fee. You know, yes, we charge a minimum of £500, but you could apply an admin fee of $299, $399 up front, and then apply a 1.5% fee at the end to be payable on completion. So again, just getting an upfront fee, covering the work you're doing initially, and then again getting that completion fee paid at completion. So essentially, charging twice. Like you say, the fee structure is there. Use it and charge fees that are appropriate for the work you're doing.
The saying I love best on fees is stand tall.
Yeah,
because it says a lot about you as an advisor. If you stand tall on your fees, you're better to do 5 mortgages with a fee than 10 mortgages with no fee, because you're going to do less work. You're going to earn the same money, if not more. And also, You're going to put yourself out there as quality, as we say. So stand tall on fees. And don't get me wrong, if you've got to compete with an existing lender and it's a product transfer, then of course you might not be able to justify charging, you know, fees that are too excessive. But, you know, the administration work that's involved, your time is money. It's you come to work and you advise on mortgages, you should be paid for your time. So definitely stand tall on that. So we'll come away from this now, Ked, and I'm going to just touch quickly on the client prep form. I don't know if you've got a prep form to hand, have you, or the actual link itself?
That's the portal.
Brilliant. So what I'd encourage people to do with this, and Kez just going to talk about it just briefly, and he's going to let you know kind of what it is and why we use it. But this goes out at points of appointment, arranging the appointment with the client and confirmation of that appointment. Now, if you're an advisor at Fortune Financial, you'll have your install, which will have a number of signatures on your Outlook system, your email system. And on the signature, you'll find there's a confirmation of mortgage appointment signature. If you drop that down, you can, by all means, press Control on your keyboard, click the logo where it says click for prep form, and you can have a go at filling it out yourself. And I'd encourage you to do that, because then you're familiar with what your customers are doing for you. So, Kate, over to you. Do you want to just run through the prep form and just explain,
Absolutely,
what this is and why we do it?
Absolutely. So that's the icon that Mark was referring to. So the client will click on that, and it will simply take them straight to this. And this is what they'll see. So it's branded. It looks great. It's easy for the client to complete because it's digital, and I mean, you look at it and you think actually it's 40 odd, 50 odd questions, but ultimately that's 20 or 25 questions for each applicant, because it might be 2 applicants that you're looking at doing. And this is all their personal information. So, it should only really, in our experience, take the client maybe 10, 15 minutes max to get this completed. And they can do it on their phone, do it on a tablet, do it on a desktop, wherever they are, they can get it done on any sort of device that they're using. Now, what clients do is some rush through it, some will just fill out quick information, and unfortunately that's not great for you, because you need as much information as possible around their names, their dates of birth, their employment status, their employer, start dates, things like that, which we'll go through. So just stress it to your client, say, look, take your time filling it out. Please ensure that you provide as much information as possible and it's as detailed as you can make it. So running through it, it's going to ask the client, what kind of mortgage we're looking for? Well, we're first-time buyers, nice and simple. It's all going to ask them, what's their budget? They might not have one, so they might just be flirting with a figure in here. They might be paying rent £1,000 a month at the moment and think, well, actually, my budget is I could probably stretch it to £1,200 a month. Okay, brilliant. It's going to ask them their title, Mr. Mrs., applicants' full names, dates of birth, national insurance numbers, which is crucial for mortgage applications, marital status. It's going to ask them nationality, again, which is important, because if you've got clients who essentially might not have something called settled status, which is really important, they might only have a pre-settled status, which means they've not been in the UK for a long enough period, that can really affect where you place that mortgage. Because again, the criteria is very different from lender to lender, especially when it comes to sort of foreign nationals and residency. So that's really important. Anticipated retirement age, we spoke about that earlier. So they're probably going to put in there 65. So have that conversation with the client and say, okay, you said you wanted to retire at 65. Tell me about that. And actually, they might say, well, actually, it's more of a goal than the definitive answer. So when we were speaking earlier about mortgage terms, etc., understanding what the actual retirement age for that client is really important. Contact telephone numbers, email addresses, dependent information. So yes, I've got dependents. Well, we want their name, their date of birth, and the relationship to the client. That's really important as well. Present residential address, including postcode, so full address in there. Again, applicant 1, applicant 2. All the questions you'll see, applicant 1, applicant 2. Scrolling down, it will ask them for the date they moved in. Now, the reason that is an important question is because whenever you're completing a decision in principle or mortgage application, or even identifying the client for anti-money laundering reasons, what you'll need 3 years worth of history, address history. So if the client tells you that actually they moved into this property last year, what it's going to ask for, it's going to ask for previous. So you'll see here, it will say previous address details, including postcode, if lived at present address for less than 3 years. So again, very, really crucial for that data that you're going to need to process any agreement in principle or mortgage application, for example. Again, previous address there for applicant 2. Main occupation. So we'll ask them, what type of occupation are they? Are they employed, self-employed? Are they a director of a limited company and a shareholder? Do they own less than 25% or more than 25% shares within that company? Again, that's a crucial question due to how the lender will assess that applicant. House person may not have an income, contractor, or they may be retired. It will ask a bit more about the main occupation. So what do? Do they work in finance? Do they work are they a builder? Are they a scaffolder? Do they work for NHS? What is it they do? Employer's name, business name, start date. Again, what you're looking for here is as much information as possible, because I see forms coming back from clients where they'll put, Fortune Financial. They won't put that, obviously, but they'll put Fortune Financial, and that's it. They won't put the address. They won't put the postcode. They won't even put their start date. So it's really important the client takes this seriously and inputs as much information as possible to enable you to do your job up front, rather than chasing information as and when you need it. Basic annual salary, overtime, commission. Again, they'll punch in a number. They'll say, "Oh, I earn £10,000." Okay, well, have a conversation with the client. I mean, Mr. Client, you've put in there in their bonus overtime or other annual income box an income of £10,000. Can you tell me a bit more about that? What is that? Oh, it's overtime. Okay, brilliant. Well, is that regular? Do you earn that every month? Oh, no, I usually do it every other month. So you understand more about what that income is, and actually whether you can make that fit the criteria for the lender, and whether it's income that we actually will be able to use or not for the affordability assessment. So again, you're getting the information, but what you're doing after you've received that form and having that appointment with the client is validating it and clarifying a lot of that information.
This is a fact-finding process, isn't it, Ked? It's as much as it's a digital link and they've filled it out, you're the advisor once again. You've got to go through this with a fine-tooth comb and make sure you've covered all angles, all needs for your customer. You've got a real understanding of your clients, because if you've got that, you're going to give them the best advice. It's that simple. Exactly
that. Yeah, because what you don't want to be doing is taking, like you say, using that box that I'm sitting there at the moment, using the overtime or other annual income and taking it as gospel that they earn £10,000 a year, going away, calculating affordability with their base salary and £10,000 a year in overtime, to then find out later down the line, actually, you can't use that income because I didn't clarify it. I didn't actually, dig deeper on that with the client and understand it more. So you didn't have a good understanding of what the client's income is. So how can you make that recommendation? How can you recommend the right lender and the right mortgage for them? So yeah, fine-tooth comb is a great example, because you need to clarify that information with the client at the appointment. Absolutely.
So show you these. Just jump in there, Ked. If you remember I'm sure you do remember the training side with Primus and the rulings and guidelines of the FCA. You've got to give an initial disclosure, then you do your fact finding, then you follow up with your recommendation. So when you book your appointment with your client, that's your opportunity to do the initial disclosure. If it's a remote appointment, of course, email them that initial disclosure document, and then it'll follow up with the email confirmation where they can click the link, complete the prep forms we're showing you now, and then you can go through it again to clarify the points and make sure that you're adhering to the guidelines of the FCA with regards to the sales process. That's really important.
Absolutely. So just scrolling toward the end of the form, this section now starts to asking around sick pay. So if they're employed, do they receive a sick pay? And it will ask what sort of level of sick pay do they receive from their employer. Statutory, 1 month, 3 months, 6 months, 12 months. And that's really important for you from a protection side of things as well. So not just getting information for you to go away and source a mortgage. It's actually, well, when you're looking at the protection, how you're going to protect that debt for the client, whether it's protecting the applicants, whether it's protecting the family, whatever it is you're doing and making a recommendation for the client, you can have that discussion with them and say, okay, I can see that you said that you get 3 months sick pay from your employer. Yeah, absolutely. Yeah, I get 3 months. I get 50% of my salary. Okay, well, what is 50% of your salary? And you can go into a much more in-depth discussion with them about that and understand actually whether that level of income, if they weren't able to earn an income and they were getting paid an element of sick pay from their employer, for example, is that income sufficient? Can they continue to pay their mortgage? Are they going to continue to be able to keep the roof over their head? So that gives you a bit more information about their income for you to make the right recommendation when it comes to things like income protection.
You've got to be careful, Ked, talking about protection we make. It's like someone's wound me up and put some new batteries in me. You'll set me off in a minute.
Can I mute?
I'll stay away from jumping in about protection. But what I would say is, of course,
I thought I'd touch on it.
No, it's important. So it is. And of course, that's what the prep form's there to do. It's to enable you to ensure the clients can not only take the mortgage out, but remain paying for it throughout the term.
Exactly that. Keep the roof over their head, especially from an advice perspective as well. If you're gonna give this client, or you're gonna facilitate this client a £300,000 mortgage to buy themselves a home, do a proper job and protect it to make sure they can stay in their home. Ultimately. So, just skipping down, accountant's details. Again, if they're self-employed, we need accountant's details. It then jumps on to credit cards, loans. So we're asking for, if you do have a credit card, what's the balance? What's the provider? Will it remain at completion? So again, we're just asking for all this information up front, and it's up to you to clarify that and make sure that the information they're putting is correct, or that you're obtaining the right information when at that appointment and through that fact-finding process. Again,
anyone now, kid, who's watching this can start to see the links between the affordability we've looked at. You're going to need the client detail, the income detail, the expenditure that we're now touching on. This platform is going to give you all that information so you can go away, and whether it's doing some initial works before your appointment, or especially when you're going to make that recommendation, make sure that you've got the tools to be able to make sure you get it right. And that's the key. Exactly that.
Because you get clients as well that want to just know what their affordability is, and what you don't want to start doing is half a job. So you don't really want to start taking some information over the phone, and the client tells you, yeah, in a salary of it's around 35k. Well, what is it? Tell me about the income. So actually, what we're going to do, Mr. Clients, I'm going to drop you an email. We're going to set up an appointment. I need you to complete this. So if you create that routine for yourself and you do the same thing for every client, you'll be able to do that. You'll be able to do a proper job and give great advice. But try and do it off half the information, you're going to get it wrong. You're going to get it wrong, and it's not what you want to be doing with clients.
So the prep form, these prep forms are important to have back. That's the key. If you've got an appointment booked on, Thursday this week, and it comes to the appointment time and the client hasn't filled out the prep form, firstly, it tells you something. Are they interested in actually getting the advice? But secondly, it puts you on the back foot, because this prep form warms the appointments up for you. It gives the ability to do some research prior, familiarize yourself with the background. They've got children, what their employment is, what they're looking to do. And then, of course, when you go into the appointment, then it's not like, back in the day where you said, right, let's start by taking your information. What's your date of birth? What's your address? How long you been there? It's dragging its feet. So I suppose the word is proactive. You're proactive in giving advice to clients, and you're putting yourself in a position to be, on a pedestal, so you can go in and really help them and meet their needs a lot quicker and
absolutely
a lot slicker.
Absolutely. And like you say, especially from again, I know you said you got you're all over the protection at the moment, but things like this section here, like height and weight, smoking status, previous medical information. So you've got all the information to then refer back to when you need it as well. So getting all that information up front, giving yourself all the tools you need to make, to make the right recommendation and do a proper job, it's key. So yeah, that's the form. That's the form. So
brilliant.
Get the clients.
Any advisors as well, Ked? If anyone's out there, they're using the form now for Fortune Financial, and you feel it needs something adding, just ask the question. We can add it in very simply. So yeah, like you say, that's the client prep form. We're just going to finalize now. I'm aware of time, and we don't want to keep people too long on this Zoom. Lender criteria. Now, it's a big one, because we've talked about 27 Tech. We've got the evidence of the research in front of you and the list of, who's the most cost effective. And at that point, you saw that Barclays came up with an exclusive product. But we need to ensure that, based on the client's circumstance, which is around the prep form, and the discussions I've had with the client, does it fit criteria? Now, for me, we can look at back to the intermediary sites, as Kate's going to show you now. This is the HSBC one. There'll be a tab for criteria, and then you can make sure that it meets the needs of the lender, not just the client. So, Kate, over to you.
Exactly that. So whether it's a particular property type, whether it's something around the client's income, we spoke about that, didn't we? Bonus, overtime. So, for instance, HSBC, we've got an overtime, Apple's got overtime income. We need to know how they're going to assess it. So this particular page, criteria for HSBC, I'm going to click on residential criteria. You can most websites allow you to search in here. So we could just put in overtime and hit, if I spell it correctly, it might help. Overtime, hit do that again, sorry. Overtime, enter. That's not quite working. So that's made me look a little bit silly there. So I'm just going to go back to this list here. So we're going to go down. It's got all different sections, but ultimately we're looking for an income section. We'll scroll down, straight down to income, and we're going to look at additional sources of income. So it's giving us things like investment, rental income. We spoke about that, buy-to-let income, maintenance income, private pension, state pension. So we're going to keep scrolling down, and you'll find actually the overtime's not in there. So I'm thinking, okay, well, where is it? How can I find that information? So it's placed in different places with different lenders. So they're all, you have to do a lot of sort of clicking to find the right section that you're after. So I know it's not an additional source of income. So I'm going to try income from employment. This looks like it might be the one. So we've got basic income and how that's assessed, top up salaries, bonus overtime commission. Perfect. So that's what I'm looking for. So with this particular product we're looking at, I wanted to see how they assess that income. So it tells me where there's overtime or bonuses, a maximum of 50% of the average amount received can be guaranteed income. So what does that mean? What's the average? And it will just go through that for you. It will tell you if it's paid quarterly, half yearly, annually, monthly. So you need to find out how that's assessed, because it might be that actually you need to find a lender who will accept 100% of that overtime, because you need to borrow a slightly higher figure. So you're jumping from lender to lender and looking at criteria. And again, it can be regarding anything. It could be credit scoring, things like missed payments, light adverse credit. Applicants who had previously missed payments on their credit commitments usually be declined. So things like that, you think, okay, that doesn't look like HSBC is the right lender for this client because they just missed the payment on their credit card or something like that. So it could be several different reasons you're looking at criteria to find the right lender for that client.
So, Kid, I want to take that first-time buyer mortgage you mentioned before, or maybe a home mover, was it, with Barclays. But I wanted to stretch the term to age 75. Can I do that?
Let's have a look for you. So the client said, I want to take a 35-year mortgage because I want to keep the payments down within budget. So I'm going to type in Barclays for intermediaries. I'm going to go to Barclays intermediary webpage. And on the top, I'm going to go lending criteria, residential. So again, you'll see the layout is very, very different from HSBC. And it's getting used to these websites and understanding how to use them and make them work for you. So we're looking at term or age. So they're the kind of two that we're looking at. So it's all in alphabetical order. Barclays age term. So I'm going to click on that and see if that gives me the information I'm after. Scroll down, hit age term. Maximum age at the end of mortgage. Usually the maximum age at the end of mortgage term should be 70 or retirement age, whichever is sooner. So that's key information there, because the client said, I want to take it to 75. Okay, Mr. Client, well, when are you planning on retire? Oh, I'm not going to retire until I'm 80. Okay, so you're going to be continuing to earn your income to the age of 75. However, what the lender's saying, what Barclays are actually saying here is that the maximum age will be 70 or the retirement, essentially whichever one is sooner. So they won't allow the client to take that mortgage to age 75. It will be maxed out at age 70. So we know that Barclays won't fit.
Well, the next in line, let's say it was HSBC.
Absolutely. So let's have a look. Let's go back to our results. So we knew at Barclays, let's say HSBC, just for argument's sake. Let's have a look. HSBC are a good example, actually. So we're going to click on residential criteria. We're going to drop that box back. So applicant, age. Again, that was a nice, easy one. Let's have a look. It's going to give us, as part of responsible lending, the maximum age is dependent on the repayment type and subject to meeting our term and lending into retirement. So there's several different things you have to understand with this one here, is because what it's saying is that they've got a lending to retirement criteria. And that doesn't mean that it's lending beyond the client's retirement age. What that means is it's probably lending into retirement beyond the age of 70. So what it's saying here, you'll see it says, where an applicant is within 10 years of the retirement age, we may ask for further evidence of pension provision. So if the client is, for example, 66 years old and they want to take it to age 75, for example, it's less than 10 years. So the actual lender in this instance is probably only going to look at their pension income, not high enough, so it's not going to work for an affordability assessment.
Never know.
So I'm going to scroll down to.
They may have a term tab.
Retirement. What's that? Sorry.
They may have a term tab, which
I'm thinking term, or in fact, I think it highlighted it for me there actually, didn't it? Term. Let's click on term and see what that. There you go, straight down to term. So it's telling us that the max term is 35 years, interest only is 25 years. Not the tab.
It's giving us all that information, isn't it? It's giving us
telling you what your maximum,
what we can work with.
Yeah, it's giving you what your maximums are. But ultimately, we want to know if we can take this mortgage to age 75, don't we? That was the question. So lending into retirement. Put me on the spot now, haven't you?
It's definitely what we wanted, and this is a prime example of, you know, maybe you have to do a little bit of work, and maybe maybe get onto the live chat with HSBC and discuss with them, you know, will it fit? And of course, it's not just about whether the lender criteria fits, it's also whether, as Kate's mentioned, the client's circumstances fits. You might want it to 75, but his planned retirement age is 70. Well, no, you can't justify that. Your income's going to stop. How are you going to afford that mortgage? And as much as they may say, well, you know, I'll probably overpay throughout the mortgage and bring it down, sadly, it's going to be underwritten based on what you're looking to take and being able to afford it over that kind of term as well. Well,
exactly that.
On this one, Kate, we kind of know that if the income's going to be there, then HSBC are probably a good option to take it to 75. Don't get me wrong, any criteria is, again, a guide. It's down to, you know, underwriting and, you know, acceptance of validation of documentation, valuation to get your mortgage offer. But, you know, as we're trying to show you here, is that, you know, the likes of HSBC, Barclays, whether it's going to be Halifax, Santander, NatWest, it doesn't matter who it is, go on the intermediary sites, look at the criteria when you're researching for your customers and your clients based on the recommendation, and make sure it fits the criteria before you're making an application.
Absolutely. Yeah, exactly that. And like Mark said there, you've got that chat with us. Click on the button, you go onto a web chat, get the answer. You know, you ask a direct question and get a direct answer. But also, just one thing about
business development managers, won't we, Kate, that you can work with and get, you know, ask questions.
Exactly.
Get the answers a little quicker.
Yeah, get all their contacts, save all their numbers in your phone, and make a phone call. Because the more you get them on your side as well, they'll be there for you when you need them. But yeah, just one thing about lending beyond 70 that's worth noting as well is if you've got someone who is in a very manual role, you know, if someone's a builder or a bricklayer or a scaffolder and they want to retire at age 75, the lender might look at that and say, well, is that realistic? Is it plausible actually that the client can do that? So be careful about trying to stretch these terms sometimes and make sure that actually it's feasible that the occupation they're in will allow them to do that.
Brilliant. So last thing from me is documents on the initial email. Can you show us the initial appointment email, Kate, that's sent out? Do you have a copy of that at all?
Yeah, it's on the screen now. Should be able to see that. So that's an email.
Yeah. We've still got HSBC at the moment on there.
How are you? Let's have a look. Give me a second. Let's see what's going on here. I'm going to stop share and start share again. Bear with me.
Again, all advisors, you'll have access to your confirmation of appointments email. On that email, of course, the client prep form link is there for them to use when they receive it. But as you can see below that, there's really some advice around, you know, the documentation that, you know, will be required. And really, they should be proactive in getting together for you to make sure you can give them the best advice. So you'll something that stands out there. There's a link as well that says checkmyfile.com at Fortune Financial. That's a free trial period on a credit file check for them. I'd encourage all your clients to do that because it paints a picture for you of all the credit accounts they have and enables you to kind of tally that against the prep form for what they're telling you, because you'll find that clients do forget about, you know, they took a sofa with DFS, or they've got a credit account with Next, or whatever it may be. So the credit file paints the picture, makes it easier for them, and makes it easier for you as an advisor to make sure you get it right. And of course, that's what it's about. But these documents that are on the screen, of course, that Kate sent there, it's showing, you know, what's going to be requested for clients that are employed or self-employed, including bank statements, and it gives you the ability to then cross-reference and really see, what it is and what their circumstance is. And once that is collectively got together, you're going to add that to your folder, send it into your case managers with the relevant documentation, and then it's ready to go. So, Cade, do you want to just stop that share quickly, and we'll just finalize by saying that, you're an advisor at Fortune Financial. It's important to know that, you're working for an established, reputable company, and your advice is not just, initial appointment, making a recommendation. It's the whole journey for the clients, and that's really important. They've got support from upfront, they've got support from the advice of the advisor, they've got support through the case management team, all the way through to completion. So they're getting value by using Fortune Financial. And for us, it's a process, it's a journey to make it stress-free, or as stress-free as it can be, and give them some confidence and trust in what we do for them. And it's a professional service we're offering. So the reason I'm telling you that is, look at the process we've gone over today, adhere to the process, firstly, the FCA and the guidelines that Primus and the FCA have put together for you. But secondly, make it your own. And by following a process, you'll find that structure gives clients real understanding of how you work and what you're going to do for them. And for me, that's real key, because if you're, jumping and from one thing to the next, asking for another document, maybe, working with half the information, then you'll get it wrong and you'll be chopping and changing, and it'll take a lot longer. So have a process to how you work, and, have a confidence in the companies. I'm sure you do anyway, that we're a team and we all look after the clients in how we'd expect them to be looked after. So I want to just say thank you to Cade for spending the time today to go over the affordability, 27 tech, client prep forms, documents, lender criteria, fees, charge fees, and of course fact finding. And any more questions, you know where we are. But hopefully that's been informative for you. So thank you for your time. Enjoy the rest of your day.
Thank you.